first, I hope everybody had a reasonably good weekend. You know, I know Matt did. He played golf yesterday. That's a good thing. All right. We're going to cover two things today. One is, if you recall, one of the things that I've provided you before, Mike likes this, is to have a number that you can use to quickly determine the principal and interest payments for your clients on the fly, without having to have this crazy calculator, okay? How can you do it? So in the past, and I think back to, a year and a half ago, the numbers that I was giving you, for example, you would take the loan amount, not the total loan amount, just the thousands. So if it was a $400,000 loan, you wouldn't multiply 4,000, you'd multiply 400 times some number. Well, those numbers were down in the low fours. Now, they're much higher. So we're going to go through that so that you've got a quick tool that you can use when someone says to you, I'd like to know what my monthly payment is. Or, as I like to do, when somebody calls me and asks me, what's my monthly payment? I say, I'm going to do two things. One, first of all, I'm going to give you what it is. Secondly, I'm going to give you a tool that you can use so that you never have to wait for me to respond. And so whenever I tell them that, by giving them the number first and then giving them this tool, they're like, oh, that makes it so easy. Yes, it does. Plus, it puts the onus of taxes, insurance, and HOA on them rather than on you or me. And why do I want to do that? Because if I tell Lanier that your taxes, I'm estimating it at $300 and it comes in at $350, you don't like me anymore. So I try to put the onus on them and see what happens. Right now it's a little bit easier because all the counties have published their taxes for 2022. So the taxes are pretty accurate right now. So let's take a moment and go through this. The second thing we're going to talk about, I'm seeing a lot of videos from all of you on something called Lock and Shop. And I want to talk about Lock and Shop today, the good and the bad of it. And, it's almost a little bit of a marketing gimmick, but, we'll go through it. So first of all, if the interest rates are 6, 6.25, 6.5, 6.75, or 7, I'll give you the number that is used that all you have to do is multiply it. So this one here, the actual number is $5.99, but I just use $6. So the way this is really tough to figure out. So if the interest rate's 6% and I have a $400,000 loan, I multiply 400, not 400,000, I multiply 400 times 6, $2,400, bam, that's the payment. And they say, well, how close is it? If I take the time to put it on here, it's within a couple dollars. So it really helps. So, but I want to show you what all of them are. You can write them down or take it off the video because it becomes a great tool. I use it all the time, as opposed to having to figure it out on here. 6.25, $6.13. Okay? And you'll see that this kind of figures its way up. 6.5 is $6.29. Really tough stuff, isn't it? 400 times 629, and there's your principal and interest payment. It's real easy. 675 is 645. And 7 is 661.
Can you just do a favor? Can you do us at 8% real quick?
What's that?
What's 8%?
8%? Have it for you in a minute.
I hear it's supposed to go up to 8, so I'm just curious what the worst case is going to be this year.
729.
So you buy 700K home, it's like $5,000 monthly payment.
You look at that and you think, oh my gosh, that sounds crazy. But honestly, this last weekend I was working with a couple and their interest rate was going to be 8.625. Now they're getting a bank statement loan, so they're going to be getting a higher loan. I mean a higher interest loan just because it's a private equity loan. It's not a Fannie Mae loan. But, you know, and I think I might have mentioned this a few weeks ago, but here's the thing for them. You know, they write off a lot. They make a lot of money, but they write off a lot. So if they write off $50,000, they write off more than this, but if they write off just $50,000 a year in personal, you know, in expenses that they would otherwise have to pay taxes on, at a 30% tax liability, $50,000, that's $15,000. So the difference between 8% and right now around 6.5% is just not that, it's $1. So they're saving a ton more money by saving money on personal income tax than they are worried about an interest rate. And that's how they feel about it. They're not worried about it because they're saving so much money on personal income tax. But you know, there's two reasons for doing this. One, it's simple, it's fast, it's easy. But there's really a better reason for using it, and you've heard me talk about it over and over and over again, and it's you and I want to be considered the most competent and trusted advisor that they have. So if you call me, Iris calls me and says, Greg, can you just tell me, my client wants to know what the principal and interest payment is on a $400,000 loan, and can you give it to me? Of course I can. So if you're my client, Iris, and I tell you, I said, I'll give it to you, but I'm going to give you something better right after I give it to you. And you say, what's that? I say, first of all, I'll give you what the payment is. And then I'm going to say, Iris, I want you to write this down. Anytime, if you'll just take $6.29, that's it. $6.29 times the number of thousands, now you know your principal interest payment. You never have to wait for me. I want you to call me, Iris. I really want you to call me. But you want to know what the payment is because you're sitting at your couch looking at this and you're not sure. You can just do this quick. Now you've got it. Then just add taxes, insurance, and HOA to it, and you know what your monthly payment is. So then Iris says, well, gee whiz, Greg knows what he's doing, and I feel like I can trust him as long as we have 3 or 4 or 5 of those conversations. So the idea of it is it's not just how simple these numbers are, but it's the fact that you can utilize that to make yourself look better in the eyes of your client. Make sense? All right. Yes?
Just to let everyone else know, there's a mortgage calculator app.
Mm-hmm.
It's pretty easy and it just gives you the same exact.
Yeah, it says same number.
Yeah, same number.
Same number. It's very simple. You know, hold on one second, folks. There we go. All right. So now, next thing I want to talk about is lock and shop, because I've been seeing you do some of you have been doing videos on lock and shop. First of all, what lock and shop means is that a borrower can lock into an interest rate before they have actually identified a property that they've gone under contract with. That's what lock and shop is. If you watch some of the TV, you'll see Rocket Mortgage advertises the heck out of lock and shop. Now, if it were as good as everybody in my industry, including my company, pitches it to be, then that would be the thing to do. But not everybody does it. Actually, very few people do it. And actually, a lot of loan officers don't promote it, me being one of them. It's available. So let me give you kind of the inside scoop on lock and shop. Well, the first thing is most mortgage companies, not 100%, most mortgage companies, if you're going to do a lock and shop, you have to go through underwriting first. That's not that it's a bad thing to have to go through underwriting. Now, for me personally, I don't get too excited about sending loans into underwriting because I don't know if the borrower is going to buy the house or not. I mean, they may or end up getting their mortgage through me or not. But if I have to go ahead and put every single borrower through underwriting, it extends the length of time that we have to have for our pre-approval. And Many of you know that have worked with me, if I tell you you're going to get a loan, you're going to get a loan. It doesn't, I've never had one not happen that way. It's not the case with every mortgage company and every loan officer, so you want to be careful. But in most organizations, they want you to go all the way to underwriting. So there's a little bit of time involved in that, and a little bit more commitment. They got to sign more papers up front in order to get that done, as opposed to just doing a very simple application, sending in documents, getting reviewed. So that's one thing. The next thing is that Lock and Shop does not look at the lowest possible rate. So for example, Chris, if you bring a client to me and they're going to close at the end, they're going to close in the middle of the third week of October. That's 30 days from now. I'm going to give them a 30-day lock. Okay? If they're under contract, I'm going to give them a 30-day lock. That makes sense, right? Now, Lock and Shop doesn't give 30-day locks.
Just quickly, are you basing how much time you're giving them? Like, is there a number that bases how much time they can have, or is that just like a personal? Like
It's all investors, all mortgage companies assign a time for Lock and Shop. It's always at least 60 days and oftentimes 90. So what happens is we look, instead of me looking at the rate for Chris's client at 30-day lock, I'm looking at it at 60 because they want to do a Lock and Shop. So Lock and Shop says I'm going to quote you the rate as though we're closing inside of 60 days. Now the difference between a 30-day and a 60-day lock period is generally about 0.25% in the rate.
So the longer period.
The longer the lock, exactly, Matt, the longer the lock, the higher the rate. So we're looking at a Lock and Shop in our case is a 60-day commitment. And generally speaking, that's 0.25 point above the 30-day price. All right, so it's not like it's outrageous, but it's a little bit higher. And if somebody's really nervous about rates, that hedges it. So somebody said, well, Greg, why do they do that? And I just used the word a moment ago, hedging, because that's what the lender is doing. The lender is hedging that loan. And so basically the client can do that themselves and say, well, wait a minute, I think I'm going to buy something the next 30 days. I want to close in 30 days. I'm playing with 0.25 point anyway, so I'll wait. So it's up to them. It's not like it's a bad thing to do. There's nothing wrong with doing Lock and Shop, except what happens after 60 days. So they don't close. I mean, they don't find a house in time to close in that 60-day window. What happens? Every lender treats it a little bit differently, but all very much the same. In our case, they can extend that Lock and Shop for 30 more days. But it's not free to do that. I don't want to get overly technical with it, but on a $100,000 loan, it would cost $200 to extend it 30 days. 200 would cost 400. 200,000 would cost 400. So it's about $200 for every 100,000. That's what it costs to extend it. So now they've gone into a Lock and Shop, and Jay's client says, I want to do that, Greg, because I want to be protected. I don't want it to go up. Well, now they can't close in 60 days. So they'll get to keep that Lock and Shop rate, but they're going to pay to extend it. A few $100, depending on the size of the loan. I mean, if a $500,000 loan cost them $1,000. So all of a sudden, it's not the best thing. Now, where is it the best thing? Two instances. One, if Jay comes to me and her client says, I want to lock it in, and we lock it in at 0.25%, and the interest rates for some reason take this spike up and they close within that 60 days, they have made out like bandits. But again, you're dealing in a short time frame. So all these negative events or positive events have to happen within a very short period of time. But that is one instance. If the rates would shoot up and you do in fact find the property and close within that 60 days, you've made out.
Is there any penalty to get out of a lock? Like if the 30 days in, some reason interest rates were to go down from what you locked into?
Okay.
Is there any penalty to get out of that?
That's two questions, okay? First question is, can they get out of it? In most companies, you're stuck in it. You're going to get what's called, if it goes past the time frame, you miss the lock, you extend it, you still miss it, you're going to get something called worst case pricing, okay? But all lock and shop programs have something called a free float down. Should the interest, once you have a property, once you've secured the property, if interest rates are lower than what they were when you locked, now they have to be a certain amount lower. It can't be just that you locked in at 6.5 and the rate's now 6 3/8. That isn't going to get you anywhere. It's got to be down a certain amount. And when we look at the rates, again, we're not looking at the 30-day price, I'm looking at the 60-day price. So I'm comparing 60-day now to 60-day previously. If that 60-day rate is at least 0.25% down, I'll be able to give them potentially a float down to whether it's an eighth off or a quarter off, something of that nature. So there is the possibility of doing that. So why wouldn't everybody do lock and shop? Any ideas?
I think it's kind of like you said, unless you know that you're going to be leaving within a certain period of time.
Yeah. How many people that you start working with buy a home inside of 60 days? You've got some. Yeah. Most of the people I'm working with, hey, seldom inside 60 days. Iris, you've got a client that's been doing it, they've been working on it for what, 5, 6 months? Yeah. And they still don't have a place. You know, I've got a client, this bank statement loan client. Now they can't do lock and shop with that one, but you know, I've been working with them since I think April. They finally found a house, they went under contract, and they terminated yesterday during due diligence. Too much work on the house. So now they're back to starting over again. I mean, that's just what happens. I've got a VA loan closing at the end of the month. And wonderful people. I've been working with them since January. You know, they've dropped out of 2 homes already. This one they're not dropping out of, thank goodness. But think about that. How many people, I mean, there is a percentage of people that, in fact, buy, you know, from the day they start to the day that they buy, it's inside 60 days. There's a percentage. It's not very big, not in my experience, but it does happen. So lock and shop may not always be for everyone, and that's the reason why. Just because the buying period runs more than the 60 days. And then it's not that, then that tool isn't so hot. Make sense? All right. Before we leave off both of these subjects, just curious, what are you seeing with appraisals right now? Coming in at value, coming in above value, coming in below. When I say value, coming in at contract sales price, above contract sales price, or below contract sales price. What are you experiencing on appraisals right now?
I've gotten some above.
What's that?
Above contract sales.
They're coming in above contract sales price, okay. Anybody else? No?
It's been a while.
You know, we've had, it seems to almost run in cycles, but right now, the last few that have come in have all been at or above contract sales price. This morning, though, the biggest one, it's a $255,000 contract sales price. The appraisal came in at $295,000.
It's awesome.
I was like, oh, yes. You know, I feel so good for the client. It's his first home. It's a condo, small one, but it's beautiful. I'm really excited because, you know, great, like all of you, great agent, not from this office, but great
You
agent.
got 20% free equity for just closing that deal?
Day one.
Jesus.
Day one.
Who was his agent?
What's that?
Who was the agent?
She's with Atlantic Communities over in Smyrna. Oh, here's a great part about that one. she goes in to show she goes in to show her client the property, and there's a listing flyer there, and my name is on it. It's an agent that used to be in this office years ago, and I do his business for him. And so,
Jeff,
what's that? No, you remember Ron? Okay. Anyway, Roberts.
oh, yeah.
Yeah, yeah. And so he's on the listing side of it. And, Jackie, my other agent's on the buying side. That's kind of cool when that happens. And so, all right. Anybody else? All right. Thanks, everybody. Appreciate it.